Hello, and welcome to this short introduction to financial ratios. This is really about understanding company accounts. We're going to look at three companies in the construction industry and decide which is the best company to invest in. Here are the income statements for the three companies. Here are their statements of financial position. Which is best? You might look at the income statement and decide, if you look at the bottom of the income statement, you might decide that A is the best one because its profit is at least 5 times as big as the other two. However, if you look at the bottom of the balance sheet, you can see that the total money invested in A is 6 times as big as the money invested in B. So really, it ought to make at least 6 times as much profit. So perhaps we can't do that. When we're looking at companies, there are three issues we ought to look at. Will it survive? Are the operations managed effectively? And how risky is it? Unfortunately, there is a financial ratio to help answer each of these questions. For a company to survive, it needs to avoid running out of cash. So it needs to have good liquidity. The ratio to measure liquidity is the acid test ratio, which is shown here. There is another ratio called the current ratio, but that's not really as rigorous as this. So for the three products, we've done the calculation, and here are their acid test ratios. Looking at A, 0.72 means that it has 72 pence available to pay for every pound of its short-term liabilities. So looking at this, A is the worst. A is most likely to go out of business in the short term. Moving on to the effective management of the funds invested, the ratio we should use here is the return on capital employed. There's the formula for return on capital employed, and here are the calculations for our three companies. A has a return on capital employed of 20%. This means that for every £1 invested, it makes 20 pence profit per year from its operations. Looking at this, down at the bottom, you can see that C is the worst performing of the three companies. B, in fact, is the best. Moving on to financial risk. A company with a high level of borrowing may have trouble in future paying the interest, repaying the loan, or complying with the terms of the loans. The ratio to detect financial risk is gearing. Here's the formula for gearing, and here are the results for our three companies. The 20% for A means that 20% of the funding is borrowed money, or that 80% of it is provided by the shareholders. So of these three companies, B has the biggest ratio. B is most dependent on lenders and is most likely to have financing problems in the medium term. So which of our three companies is best? You may have noticed that each of the three companies has a significant weakness. One is got a survival problem, one is not very profitable, and one has gearing risk. B was the most profitable, but it appears to be riskier. However, this would be attractive to some investors. So that's a quick look at the three main ratios we can use. Just a warning here that financial ratios only provide an indication of strengths and weaknesses, and they should usually be supplemented with additional analysis. Also, in order to keep this explanation brief, my analysis has been somewhat oversimplified. Nevertheless, it does provide a good starting point. There are plenty of other ratios which can be used to help us understand what lies behind the problems that we might just have identified with liquidity, profitability, or financial risk. If you would like more information on this topic, please follow the link on the next page. Thank you for your attention.